So, man, CPI kind of paved the way for what's to come. That low of reading, no one expected it to come in like that. I mean, it wasn't super low, but it came in below expectations. When all people thought we were going to hit right at expectations, this is a big win. This is a big move for the bond market. This is a huge rally for the mortgage side of things. And guys, I'm telling you what, I think this applies ultimate pressure for July for the Federal Reserve to go, wait a minute, we got a runaway labor market. Unemployment's starting to get out of control. It's at that 4.1. I mean, 17 of the 19 members are sitting over there going, man, this is not good. I think you're going to see that rate cut in July, and I think this kind of paved the way with combination of the labor market. So if not July, you know it's coming in September, but I think this kind of leads to a back-to-back cut of what could happen here. Welcome back to the What's More podcast. I'm your host, Quinton Harris. You're dialed in for episode 179. And hey, you know what? It's the million-dollar question. Are rates going to go up? Are they going to go down? When we say rates, we mean is the Fed going to cut rates? And you know, I think we got a smoke signal of things to come. Actually, I think we got more than that. I think we got some clarity. What I think we got Tuesday with Jerome Powell's testimony at the Senate Banking Committee was, hey, listen, yeah, September, you're going to get it. Maybe in July, it's a topic of debate. And he said it's one key feature right now. And as I look at my notes here, he said, listen, we are definitely worried about weakness in the labor markets and that could be the case for a cut. It's the first time he's come out and actually stated that and said that. You know, we did kind of hear that from Raphael Bostic when I talk about that fireside chat that Daniel and I sat in with him on with a group of about 50 people here in Jacksonville, Florida. He said the exact same thing, and that was 2 months ago. So it's clear behind doors, Federal Reserve are worried about the labor market. This is something that I think is more important than a 2% target rate. I think they're sitting back saying, hey, listen, this is our mandate 2% target rate. But as we've said before, you know, when that labor market starts to deteriorate, this is not a slow deterioration. It is a rapid runaway train. And it's something that I think the Federal Reserve is putting the brakes on and saying, listen, we've got problems. Because if you go back to our last episode, I want you to go to our YouTube channel at What's Your One More with the number one. If you haven't got a chance to subscribe to that, please do so. My producer puts all of our graphs, all the information, all the charts, like I'm getting ready to talk about, are in that episode. But this particular chart shows where 17 of the 19 FOMC members are saying, listen, we are very, very concerned. 4.1. Even 11 of them at 3.9 said we got a problem. Houston, we have a problem at 3.9. 4.1, 17 of the 19 FOMC members said, listen, this is not good. And that it would be a reason for us to cut rates. Well, guess what? We're at 4.1 now. And by the time they meet, the next unemployment number is not going to come out. But there's a high probability it's going to be higher than 4.1. We get to 4.2. They are in that Top Gun danger zone. And that is not where they want to live. It's not where they want to be. Remember, we talked about we're in a political season. The Federal Reserve is political, but they're not political, but they're politically aware, right? They are aware. They do not want to be the topic of conversation in these debates. I'm not even going to get on the topic of the last debate, what happens, because, you know, we don't have a time show for golf. But the reality is this. In this particular debate, they do not want to be the ones that are blamed for the economy and what's going on here. So I will say this. This was interesting because he said, hey, listen, the basically cutting interest rates too early or too late could be detrimental to the economy. Well, I agree with that. No one knows the perfect entry point on this. But he has also said that we also realize that elevated inflation is not the only risk that we face right now. Now, I thought that was really interesting because that's something that he hasn't pointed out before. I mean, think about that. Elevated inflation is not the only risk we face. Well, yeah, that's because the labor market is a much bigger issue than inflation right now. If you recall, they've talked about their target rate at 2%, right? So their favorite form of inflation is the PCE, the core reading. Well, we already got a 2 handle on that. We already got that. I mean, granted, we're not too flat, but we're in the 2s. You're there. And to get it all the way to a flat 2%, that is going to take a significant amount of months of readings, lower than the previous year's month, to get it there. I don't think they're going to obtain. I don't think they're going to ascertain that. I do not think they're going to get there. I think they're already there. And I'm not saying, hey, let's settle and be happy with what we got. But I'm saying that labor market is a much bigger concern. And as these numbers start to come in, year over year, month over month, we're starting to see significant declines. As a matter of fact, that unemployment rate is the lowest we've seen since November of 2021. Let that sit in for a minute. Yeah. It's not the highest of record, but it's the highest in the last almost 3 years that we've had. That's something to be concerned with because it's only gone up month over month over month over the last 3 months. So that's something I think is in the background stewing. I do think without getting a PCE reading right before that meeting, without getting that data before they go in there, I think it's all going to come down to, hey, listen, how comfortable are we with this week's CPI reading, right? So, man, CPI kind of paved the way for what's to come. That low of reading, No one expected it to come in like that. I mean, it wasn't super low, but it came in below expectations. When all people thought we were going to hit right at expectations, this is a big win. This is a big move for the bond market. This is a huge rally for the mortgage side of things. And guys, I'm telling you what, I think this applies ultimate pressure for July for the Federal Reserve to go, wait a minute, we got a runaway labor market. Unemployment's starting to get out of control. It's at that 4.1. I mean, 17 of the 19 members are sitting over there going, man, this is not good. I think you're going to see that rate cut in July. And I think this kind of paved the way with combination of the labor market. So if not July, you know it's coming in September, but I think this kind of leads to a back-to-back cut of what could happen here. But hey, moving on to the next topic here. Have you recently applied for a loan, recently being in the last 3 years? And among applying, you start getting phone calls from other people that you don't know why you're getting them and where they're coming from. What's interesting to me is these are called trigger leads, right? We did a whole episode 51 on trigger leads. If you get a chance, go back to episode 51. We break down how these came about. We break down where they're coming from, what they mean, but a quick summary, quick recap if you haven't had a chance or don't get a chance to listen to it. Think about this. A trigger lead is your information as a borrower. So you're applying for a loan. When you do, you disclose a ton of personal financial information. More importantly, you give all of what we call non-public private information, social security number, date of birth, etc. It goes to a lender that you trust, a trusted source, someone that you chose to give that information to. And they are preparing a loan product for you to choose. And then you hang up the phone, and within seconds to minutes later, you're receiving another phone call from someone that's pretending to be part of that lender. That is what's happening in our world right now. And when markets constrict and times get tougher, these become more abundant. These are leeches. These are people that are mooching off of marketing dollars and relationships of other lenders. And how is this happening? Well, quickly, I'll tell you how it's happening. The credit repositories are selling that information to other lenders. And they're doing it on the notion that these other lenders are going to offer you a firm offer of credit. Now, what is a firm offer of credit? In this scenario, a firm offer of credit would be if a competing lender says, hey, listen, based on your credit score, based on your credit profile and the information that came to us from the credit repositories, we will give you a loan of X at this term and this percentage for this dollar amount. That's a firm offer of credit. Like they're giving to you that. Can't guarantee it, but we're offering that to you and we can stand by that offer based on what we have on file. Now, if something's different than what they have on file, obviously they can't honor that. But the reality is the firm offer of credit is there based on what they have. And if you can provide everything that's in there, you're going to get that loan. That's a firm offer of credit. That's not what's happening, but that's why they're being sold. That's kind of the pitch to make the sale. And by the way, these are being sold for pennies on the dollar. But what's happening is it's being sold to what I consider to be wolves in sheep's clothing. There's no firm offer of credit being made. These are people that are working at call centers. Hell, they may be working out of their house. These are not professional lenders. These are leeches. I'm going to go back to this. If you ask any professional in the industry right now, hey, what's your biggest challenge? They're going to say these damn triggers, man. They're horrible. They're messing up everything. And I agree. I couldn't agree more. Because what they're doing is they're going behind you. And like I said, within seconds, these phone calls are being made. And the reason it's seconds to minutes is technology has caught up so quickly to this. You know, these things originated in 2002. The practice of buying trigger leads became a thing in 2002. And so at that time, what happened is you would get like an Excel dump list of people's names, phone numbers, emails. You get the point. The credit profile is sent to you with the credit score. And then at that time, someone would have to scrub that data and make sure they're not on the do not call list. They're not on the opt-out pre-screen list, all these different things before they even made the call. So it would take days, sometimes weeks for that call to be made. Well, now with technology, all this stuff has happened instantaneously, and the outbound call is being made by computer software. And next thing you know, someone's on the phone, and they know that you are working with a lender. Now, they may not know who the lender is, but they know you're working with a lender. And these people, they are slick. They are conniving. They know what they're doing. They have scripts. They call to and pretend to be part of the lender. They pretend to be part of your lending team. It's a very disgusting, disturbing practice, but it happens. And as a customer, I mean, imagine you just got done going through an entire situation with someone on the phone, again, giving personal, non-private information, and you get a phone call like that, and someone calls back and says, hey, we need to go back over some information from the last phone call we just had. You're like, oh, okay, well, that makes sense. I mean, you could see how that would happen, right? To question that would actually make less sense than to actually take the call. I get it, right? Because it's so timely as it's happening. But the reality is they're not part of your lending team. The reality is they're usually not, most of the time, not giving you a better deal. Matter of fact, if you look at all the complaints being filed with the Consumer Financial Bureau, they are not good deals. They're actually scheme artists, right? And it's a terrible thing. So there is a bill up to the House and the Senate. And I talked about this back on episode 51. It's been there for some time. HR 2656. It has not been sent to the House, which means it's still in like a holding pattern, which is pretty crazy to think we're still there. But I bring this up because recently more attention has been brought to this. More senators, more congressmen and women have jumped on this, and they're saying, hey, listen, this is a problem. Clearly, their constituents are getting to them saying, what in the heck is going on? Maybe even one of them has had to been a victim of this trigger situation. Who knows? But the reality is this bill is up. It needs to be passed. HR 2656. You get a chance to write your congressman or congresswoman, do this. This is something that needs more attention and needs to be driven home because of the practice of deception that's happening with this. It is not good. And if you're a consumer, I highly recommend that if you receive a phone call from someone you haven't spoken to that is initiating to be part of the lending team that you're working with, you need to hang that phone up and call the person back that you spoke with directly and confirm that that person is part of the team. Have them send you an email. Make sure that you can verify all their credentials and who they are. Look them up. They should have an identification number known as a NMLS number. You should be able to go to the National Mortgage Licensing System. Matter of fact, we're going to put that link on this YouTube channel here, that NMLS lookup. You can go look up their number and see exactly who they are and who they're working with. Even if they're pretending to be someone they're not, that number will identify who they work for and where their brand is, who their brand is and who they're working with. And if it's not your company, then you know that's a fraud call. But this is important because as a consumer, you have rights, obviously, but you also have the right to investigate who you're working with and who's calling you. So I highly recommend that. Again, this bill has not been passed, but I can tell you this, there's not a professional in the world in this industry that isn't sick and tired of these particular types of leeches. I'll continue to say it over and over again, who at these deceptive practices that continue to ruin deals for borrowers and put borrowers in negative, bad situations. Again, you should go look at the CFPB, the thousands of complaints that are there, particular issue. I'm going to get off my high horse. Let's get ready for that FOMC meeting. Hopefully we get a rate cut. If not, we know it's coming in September. And hey, listen, all bets are on until September, and then the rally starts. Guys, have a great day. If you like what you listen to, please, please, please share this podcast. If you would, 5-star review it on Apple, 5-star review it on Spotify, leave comments, and also go to our YouTube channel at What You Want More. We'd love to hear your feedback. We continue to answer all the questions you put on there. We continue to value the comments you put on there and appreciate your opinions. Guys, have a wonderful week. We'll see you at the next episode of What You Want More.
I got one more shot, I'm gonna make it. One more chance, I'm gonna take it. I meant it when I said it, now it's time for me to do it. I got one